All right, Nick, Lena, nice to see you. Lena, thanks for joining from New York and Nick from San Francisco. Hello and welcome. I'm Helen Dietz. I'm Managing Director and Partner here at Aspiriant, and I'll be your host for our brief but very focused conversation on navigating executive compensation. Aspiriant is a leading wealth management firm, and we have decades of expertise and experience providing advice on executive compensation specifically. So I'd like to introduce you to my two partners and panelists, Nick Frizette and Lena Sanchez. Both are senior managers in total wealth management, and they're my partners at Aspiriant. So today, Nick and Lena are going to be sharing insights into managing decisions and strategies around your company stock, whether they're RSUs, ISOs, and also we'll touch on deferred compensation plans. And what I'm going to do is I'm going to tee up the conversation by framing it by identifying three specific points on what we're calling the executive career arc. And we'll be providing strategies for each of these executive career periods. So on the far left, you're going to see the rise. That's really when you're getting started. We'll talk a little bit about that, what happens in that period. In the center is the peak, and that can go on for decades. And then we're calling the third part, it's not the end, but on the very left side, excuse me, on the very right side, it's the paradigm shift. So before we get started, a little bit on our housekeeping. For questions you may have during the presentation, use the chat box at the bottom of the screen. A few other housekeeping items. There'll be a recording, which you can review and hear afterwards. You can find some helpful PDFs on executive compensation and more information about Aspiriant by clicking the resource link at the bottom of the screen. And while we won't be able to cover everything today, we are here to help after the fact. Those registered will receive an email to sign up for a complimentary strategy session with the team. So with that, let's begin. So as I said, I want to walk through and help you with the setup by setting the stage for the executive arc. And it's our framework, and we're going to use it to help executives understand how their financial decisions and opportunities evolve over time. So again, we've identified three major periods during your career. And we're calling that first one the rise. And as I mentioned, that's on the very left side of the image that we have on the screen. And this is the early stage of your journey. It's where equity starts to enter the picture. You're not just getting salary. We really want foundational planning to start. And you're starting to think more strategically about your compensation beyond just salary. As we move through your career, and speaking with you and advising our executives, you're really in the next stage, which is the peak area, and that can last for decades. And this is where you're in the C-suite phase, when compensation becomes much more complex, your packages are more diverse, diversifying your assets becomes critical, and your planning needs evolve to manage tax exposure, liquidity, and we'll also begin to align your wealth with your long-term goals. And then the third phase, and that's on the far right, again, it's the paradigm shift. And again, it's a shift. We originally had it as a transition, but we felt that would go on too long and you wouldn't know really where that started or ended. But it's a shift, and it's the stage that begins several years before retirement or any major career pivot. Here, the planning shifts from accumulation to distribution. We're focused on timing, payouts, creating retirement income streams that you can depend on, managing your cash flow, and minimizing your taxes. And it's no longer just about growing wealth. It's about protecting it, using it intentionally, and making sure it aligns with your values and the visions you have for your next chapter, which again can go on for many decades. So I'm going to start with Lena, and we're going to set up the conversation with you all to talk about the rise. And again, the rise is that first part on the far left. We're defining the rise when you're the founder of an early startup, or you're an early employee at a startup company, or you may be transitioning to a senior leadership position in a C-suite for the very first time. So Lena, when you're meeting a client, where should this founder or this executive start when equity in their company is the main source of their compensation?
It's a good question, Helen. So equity compensation is a great thing, but there's a lot more to think about it once it enters the picture. So it shifts how you need to think about your finances because it does add a whole new layer of complexity. So I'll share a client story that really puts your question into context. So 3 years ago, a new client came to us. She had been promoted to an executive role at a high growth tech company, and she had joined pre-IPO'd, accumulated a meaningful amount of RSUs, ISOs, and after the company went public, she of course continues to receive ongoing equity. So her base salary was around 200,000, but the real upside was in her equity grants because it almost quadruples her total compensation annually. And I'll never forget when we first started working together, she said to me, I know on paper it looks great, but I don't feel it. I don't feel my wealth. And she had a few $1 million just from vested grants alone. So she also said, I love to splurge once in a while without overthinking it, but I just have no idea what I actually can afford or how to even think about what I have or my cash flow.
Lena, that client situation is so relatable and so, I would say, common just in the very
Mhm.
beginning when clients are getting wealth for the very first time. It becomes that aha moment of I'm recognizing my wealth. I actually have a balance sheet. And now I need to start navigating my equity correctly so I can capitalize on it.
Exactly, Helen. And like you said, it's incredibly common. We hear this from clients so often that come to us that are in this stage. And when equity becomes a big part of your compensation, it can feel intangible. It's paper wealth that you have, but you're hesitant to actually access it or essentially rely on it.
And that's really what we find is this personal financial plan can really make the difference. It gives you all the data in front of you, and you can really see yourself and how your wealth really is evolving. You can see how your stock impacts your balance sheet each year. You can project and be a little bit more clear and have clarity. Otherwise, we're finding clients aren't necessarily connecting the dots because you're so busy working at that company.
Right, Helen. So having a framework in place, it makes a huge difference. It's really hard to make confident decisions, even about the fun stuff. So with this client in particular, how we started working together was just by getting clarity on what she actually had, the types of grants, the vesting schedule, the net value, the whole picture for her. And this step is foundational because equity compensation oftentimes can include a combination of different types of grants, and each with different tax treatments and conditions. So, without understanding how everything fits together, it's really hard to plan or to know how it impacts your overall financial picture. So for her, once we had that clarity, we brought this to life by modeling everything in our planning software, just showing how everything would unfold for her over time, factoring in taxes as the shares vested, and just projecting the impact on her annual cash flow. So just seeing this mapped out made it feel real. It gave her a sense of clarity and to an extent, a sense of control that she didn't feel before.
Lena, I really think it's important about this modeling. I think what we do is we run a lot of what if scenarios for clients, like what is the stock price? What if I sell? What are the tax implications? Should I wait for the stock price to go up another 20 or 30%? And it really provides taking the emotion out of the equation. I remember during the run up in the tech markets in the mid 90s and sitting with a client, and we had planned out when they could retire or their financial plan. And because stock was moving so quickly into the stratosphere, where we expected the stock to be in 10 years kind of actually happened in the first 6 months. And it was really that aha moment of saying, time value of money is like, take this now. You are worth more than the company is earning. And I remember sitting there and it was obvious. But at that time you have so much emotion, especially during that period of time, that having an advisor doing these what if scenarios, thinking about time value of money, capitalizing on it was really helpful.
Right, Helen.
Yeah. So Lena, after you have this base plan and you've done the modeling, what's next for your client?
Yeah, so from there, we focus on putting a structure in place to help her really manage her equity thoughtfully over time by just helping her understand one, her flexibility, and two, building consistent habits, which are so important. When you're near to equity, oftentimes clients don't realize, or it takes them some time to adjust in terms of blackout periods or insider restrictions and how they could limit when and how they could actually act on their equity. So that's why understanding those limits early on is so important, especially when you're planning around selling or gifting or donating shares. On the habit building side, the focus was all about staying ahead of key decision points because equity vests over time, but trading windows can sneak up on you. So simple things like setting up calendar reminders just to check in around key dates made such a difference for her because this helped us be intentional about what to do with her grants, sell, exercise, or hold based on what was going on in her life at the time. We also stayed ahead of taxes by working closely with her CPA, getting into a cadence to review her withholding elections as things change. Also, keeping her CPA in the loop was so important when there were any changes to her income to make sure that they were being captured in her tax projections. And this is key because as your equity compensation grows, so does your tax bill. And for example, in the case of RSUs, often they don't withhold enough automatically for taxes, which can lead to unexpected and unpleasant tax surprises. And that's why it's so important just having a strategy in place as well in terms of raising cash when needed and being thoughtful about which shares to sell and keeping tax efficiency in mind when doing so.
Lena, that's so important on those RSUs because typically there's the minimum tax held on the federal side and the state side, which tends to be about 37%, but sometimes we're finding our clients in the 50% tax bracket. So that's a big delta that you need to be planning for during the year. So really good point. Lena, you've mentioned blackout periods, open trading windows, building good habits, integrating your tax professional into the process, which is so important. You don't want to be surprised come April 15th. Any other strategies you'd like to share with insiders specifically?
Yeah, I like to mention 10b5-1 plans. They could be a really powerful planning tool for insiders specifically. And simply put, what that is just a pre-scheduled trading plan that you set up in advance with your company. And this allows you to sell your vested shares just based on the set schedule, which in turn helps avoid the hassle of staying on top of your open windows. So it's definitely something worth considering if you're in this diversification plan for yourself.
Yeah, that's a really great point, Lena. And I think the most important part when you're setting up a 10b5 plan is don't get too cute. Make it pretty simple. Set it on a regular schedule, whether it's monthly or quarterly. It's sort of like dollar cost averaging. Pick your stock points. You can design these plans any way you want. They could be over 6 months, then they expire, or a year. And you really want to get ahead of this. The other thing, it really allows executives to be trading if they have information that would avoid for them to be trading in an open window. The plan just allows it to take place and happen automatically. Lena, anything else you want to sum up on your key takeaways for this area of the rise?
Of course, Ellen. So if you're in this stage, if there are three actionable things that I could leave you with, it would be first, Just get clear on what you've been granted, know what kind of equity you have, and just have a general understanding of how it works. Second, planning is essential. There may be ways and strategies to mitigate your tax liability. So, timing and proactive planning make a real difference. And third, build a simple system for yourself to stay on top of your equity. Again, calendar your key equity dates, align reviews with compensation conversation, and start partnering with a wealth advisor earlier on. You don't need to become an expert on equity compensation yourself, but you do need a roadmap and the right team around you, because having the right guidance is what can help you turn that hard-earned equity into lasting wealth for yourselves.
Lena, that was really a great case study from this initial grant of this client to making her feel that she could recognize her wealth, actually own it, and then taking the right steps. So, big takeaway here is spend time, know what you have, invest in your planning around equity, build good systems, and I would just say wash, rinse, and repeat. So we're going to leave the rise period starting off in your career, and now we're going to enter into that peak middle section, which again, it can go on for decades. And I'm going to have Nick help me with this part of the conversation. Nick, how will your strategy evolve, and what are the new decisions you'll need to be making when you're thinking about the peak period? We know leading professionals and executives accumulate meaningful equity over the years and even decades. And now you're vested and you own a highly concentrated stock position. And it's a number on your balance sheet, and it's growing and growing and growing, and you're seeing your wealth there, but it's also creating risk. So what we find is that these two forces can be both true at the same time. Lots of growth, lots of wealth, but also the recognition that there's a lot of risk with that. Nick, how can executives start thinking strategically once it's time to move the value off the company's balance sheet and onto your own personal balance sheet and meet your personal goals?
Yeah, it's such an important question and such an important time in a career as well. And it reminds me of a phrase that I've heard from a few different clients totally separately. Something like, we've got a real company, or we've got a real business here, or this is starting to look and feel like real wealth. And these clients are, at or near the peak of their professional careers. And what they want to do is make sure that there are more more peaks rather, ahead for their personal financial picture. So early on, as Lena talked about, it's all about focusing on building and working in the business. And through that, you'll be creating value and accumulating wealth. But eventually you hit a point where your equity becomes more than just compensation. It becomes real wealth. And with that point comes, certainly complexity, definitely some concentration risk, Helen, as you mentioned, and frankly, some vulnerability. So I'll build on the client story that Lena shared with a client story of my own. This client co-founded a company, and for years we would check in and have meetings, around their portfolio and their financial plan, et cetera. And there wasn't really much planning to do with their founder shares and their equity, because the client was still very much in the weeds and building the business. They didn't yet know that it would become the success that it has today. Then, first liquidity event happens. We tell them to take advantage of that. Then business continues to grow, additional liquidity events come along, liquidity opportunities come along. And the client felt that they had some real wealth and their business was real. So that's when we dove even further into strategizing around their wealth.
So Nick, how did your conversation with clients change after this point? Like what did you begin to focus on?
Yeah, in this situation and with many clients, there comes a point where the focus changes from accumulation to conversion. So this client started focusing on turning the equity that they had built and had grown to make up a significant portion of their balance sheet into something a little bit more meaningful. A diversified portfolio to support their long-term personal financial goals, trusts and vehicles for their children and future generations, and then even a charitable legacy for the longer term.
Yeah, Nick, I really like your phrase from accumulation to conversion, and getting clients to move from just seeing it on their balance sheet to actually beginning to do something with it. What I also like about what you're describing is that you're becoming proactive. You're taking advantage of your wealth. and your concentrated position. Nick, do you see a common theme and thread in your conversations with clients during these asset conversion periods?
Yeah, certainly. There's definitely some common, I would say, conversations that we're having around liquidity and timing, which Lena mentioned, around diversification, which we've touched on a little bit as well. And then also we start to focus a little bit more on legacy planning. And this all really ties back to the client's, long-term financial plan. That's based on their current and future goals, really understanding what they have today and what it might mean for the future. So the first conversation we have is often around liquidity and timing. And Lena mentioned this, it's different for private companies and public companies, but it's really when to sell shares. If you're private, do you take advantage of those tender offers that are coming along? If it's public, when can you sell? Do you have, there's probably trading windows that you have to observe. There might be shareholder requirements depending on your level within an organization. So really understanding the rules that you have to play by and the opportunities that are available is extremely important. It's kind of interesting. Some clients, have been through a few cycles with different companies, and the first time around, maybe they didn't diversify as much as they wish they would have.
Yeah, Nick, I found that many clients that I work with, that if you get that second chance, you really learn from not doing it and diversifying that first stock option and grant that you have. But yeah, it's a valuable lesson. But can you go on a little bit more about that?
Yeah, for sure. They maybe miss it out on the first time around. So the second time around, the client I was just talking of actually was very in tune with their opportunities, very, very in tune with the abilities that they had and when they were able to diversify. And that diversification is sort of the next conversation around diversification and risk management. We strongly encourage clients to take any meaningful diversification opportunities that present themselves. Definitely earlier on in your career, that's the case. In this peak phase, we do talk a little bit more about how to diversify thoughtfully, manage taxes, and also help use equity that they've accumulated to meet other goals. So in addition to selling shares just for your personal needs, we talk about donating shares to charity like a donor advised fund or even a charitable remainder trust. The third conversation we have is about legacy planning. And this is where it gets, conversations get really personal, not just, what do you want to be like, what do you want to have financially, but also how do you want to be seen as a leader, a parent, a partner and a member of your community? And what role does your wealth play in that bigger picture? It could be funding college, not only for your kids, but maybe extended family members or future generations. And then also getting more involved in community, supporting things, a lot of folks have philanthropic intent and they like to see that play out as well.
Yeah, so the key conversations you're really having in this period of time on the peak is really liquidity timing, using strategies Lena highlighted in the beginning, the 83B, habits, setting up schedules to sell your stock. Then you move to diversification and risk management. You highlighted that idea of accumulation to conversion. And then lastly, legacy planning. What is the real meaning of your wealth? What are you going to do with it? What's your legacy as you're starting to think about your family and the next part of your life? I've noticed similarities across these three things. Can you talk a little bit more about them?
Yeah, definitely the thread through all of them is the client's long-term financial plan. So really, taking the time to define and understand your goals really allows us to build that financial plan and really allows you to understand the context in that plan that your wealth might have. So the equity that you've built up over time and what it might mean for your values and your vision for the future.
And Nick, any final key takeaways during these peak areas of dealing with your equity?
Yeah, probably just one on concentrated equity. We're financial advisors. We talk about diversification a lot, but we've seen it, too many times. Concentrated equity can be very powerful on the way up, but if you don't take the time to manage that wealth, manage that equity, it could end up just being a volatile single stock position, and unfortunately, that value can disappear much quicker than it arrived.
Yeah, Nick, that's so true. I mean, actually, turning that into real wealth, selling that stock, buying that piece of property, buying that second home, that's so meaningful because you actually can now live in your stock. I remember, clients during, again, the peak area of the stocks during 2007 when things were going, gangbusters again. Taking that stock and turning it into something that they can enjoy was very meaningful. Lena and Nick, we're at the home stretch of the executive career arc. We have one last point to go over, and this is the area that we're calling the paradigm shift. Eventually, we recognize in working with our clients, another shift is happening. And again, it's not just financially, but it's also emotionally. And we've worked with clients, typically we've worked with clients, 5 years, 10 years, 15 years, 20 years. So we really have been involved from the beginning of their careers to them becoming extremely successful. And now it's that third part. And they've converted enough concentrated stock equity. You've got a diversified portfolio, so you're not dependent on one company. You are very comfortable with your lifelong income stream. But the question becomes, what's next? What am I going to do next? And that transition from accumulation to diversification, liquidity is a real turning point. You've put in the work, you've worked really, really hard. You've been intentional about managing your equity. And now you're starting to look ahead. Things are a little bit different. This is where things begin to change, not just financially, but personally and emotionally. So we typically, during the next period, which is this paradigm shift, we're preparing our clients, and it's usually 3, 5, or maybe 7 years out from retirement or a major career pivot. And that major career pivot could be, volunteer, it could be nonprofit work, it could be going on a board. And we're finding our clients' thinking evolves, and you're asking an entirely new set of questions. And you need different strategy. It's now no longer about building and growing your wealth. You're now asking questions of, how do I preserve it? How do I transfer it to my children? How do I make it last? And it's what makes this next chapter, look a lot different than it did in the past, in the prior 10 years. So Nick, when you're advising clients, how are you guiding them through this next phase?
Yeah, it's definitely a shift, Helen. It's the phase is often less, as you kind of mentioned, less about maximizing upside and more about minimizing regret. But importantly, and we do talk about this a lot with clients, importantly, it's about having fun as well. So, taking the time to do the fun things that you maybe weren't able to do as a busy executive, like travel or cooking or whatever that might be. But, folks in this phase have likely built a meaningful, net worth. And the challenge now is to shift from being an earner to being a steward of your capital, of your time, and of your future. And that mindset shift certainly isn't easy. I work with one client who recently left the C-suite, and we've had a lot of conversations with this client. Some of them have been around more the logistics of just, no longer getting a steady paycheck. So, how does the wealth that you've built translate to your ongoing cash flow? So this client likes to just receive a retirement paycheck in their account regularly. Some clients like to have a balance of cash that they manage over time. Other clients join boards, so we help them manage around the cash component of that income as well as the equity component. A lot of clients also have, substantial exposure to their company stock through existing holdings and maybe even future vesting. So we're checking in on that. So there's definitely some logistics and more, in the weeds financial planning topics. But this phase is also where we see the plan become even more personal, because clients have the time to focus more on aligning their wealth with their lives and their legacies, and not just, their work.
Lena, anything you want to add here?
Yeah, so I'll mirror all the great points that Nick just mentioned, more at a higher level. In terms of this stage, this is really where the values-based planning takes the center stage for clients. the conversation shifts. It's no longer about the numbers. We're asking deeper questions. It's all about what the wealth that you built can actually make possible for you and your family, and building a plan that ties everything together, that helps you weigh in all your goals and understand the potential trade-offs to bring your bigger vision to life, and to just give you that security that you can move forward confidently in terms of what you want to accomplish.
Yeah, thank you both. So we are almost up against time, and we want to hear from our audience. So we have a few questions that have shown up in the chat, and I'm going to just throw the first one out to you, Nick. So the question is, how do you help clients decide whether an 83B election is the right move, especially in early stage companies or startups?
Yeah, it's a great question. Something we see a lot with clients, especially here in the Bay Area. An 83B election allows you to pay taxes, allows you to elect to pay taxes before they're actually due. So you could pay taxes on the value of your equity when you receive it at grant, rather than in the future when hopefully the value has gone up. So we see this a lot with folks, and there's some risk involved in paying those taxes early. But if you're confident in the business, it can make a lot of sense and can save a lot in taxes down the road.
Thanks.
Yeah,
Go ahead, Lena. I think you have a story about the 83B election.
yeah, Helen, I was just going to tie it back to the original client story that I had mentioned. Because she was at the company pre-IPO, and if she had came to us at that time and we found out that she had been granted early exercise stock, and if she was eligible, then we would have walked her through whether that 83B election made sense for her, and that could have significantly reduced her tax liability down the road, especially as her company's value continued to grow. But just like many executives, she didn't know what the 83B election was until much later, when it was no longer an option. So when clients come to us early, especially at a startup or a high growth company, we look at what kind of equity they've been granted, whether early exercise is allowed for them, how low the valuations are at the time, and if they have the cash flow and risk tolerance to pay those taxes now for the potential upside. It's also important to know that with this type of elections, there's certain implications in terms to qualifying to meet that criteria. And also time is of the essence, because if you are eligible for this, then there is a 30-day window of grant date to make this type of election.
So Lena, this is usually when you first are signing your agreement with the company, you're giving options. You've got to make the decision like 30 days and file it with your taxes. Also, just a point on the 83B, it's really advantageous because you're turning ordinary income grants into long-term capital gains, which is really valuable later on when you're selling the company. One other question. Well, there's actually two questions. So one, what are your thoughts, Lena and Nick, on using deferred compensation plans with your executive package?
Yeah, so I'll preface it just by touching upon what deferred compensation plan is. And I know, Nick, your client story in particular had to do with this, so I'll let you share that. But in terms of deferred compensation plan, it's just a type of account, type of plan that allows you to delay receiving a portion of your income, like your bonus or your base salary, or a combination of both, to a future year, usually when your tax rate might be lower, like either in retirement or post exit from your company. And the real value comes from planning around that payout schedule.
Yeah, definitely. One of the clients that I mentioned earlier, actually started getting their retirement paycheck a couple of years before they retired. So in those final few years, they really maximized their deferred compensation contributions and started living more off of the portfolio. And that allowed them to spread out the income that they were going to take in those final 2 years over a number of years past their retirement, when their tax rate is going to be a little bit lower, because they don't have those massive equity grants that are pushing them all the way up to the top bracket.
Excellent use of deferred comp. We have one last question we'll take, and this is someone who's a chief marketing officer at a tech company. It's a public company. And they're trying to understand their stock option protection choices or strategies. So, Nick, do you want to answer that?
Yeah, there's a lot there, so we probably want to ask some more questions on this one. But generally, for CMOs, other corporate insiders, traditional hedging strategies are off limits because of SEC regulations and company trading policies. So there's probably more to learn on that specific question. But that's what I'd say for now.
I would agree with you, Nick. But I would add to that again, going back to that 10b5-1 plan, although it's not a hedge in the classic sense, it is a way to manage risk and create liquidity. And typically, once you do leave the company, you'll still likely have a concentrated position. And that's when you can really start looking into more traditional hedging strategies to help protect and diversify that holding. But like Nick said, you're likely very limited, but however, there may be some flexibility to that we would have to learn.
Lena, that's a really good point, because sometimes when you're retiring, you may not be able to sell because you may have insider information like for the next 90 days. So you may be out of pocket to diversify and need to wait for the next cycle to come in. So that's just a good reminder when people are coming up on their retirement planning. That's all the time we have for questions. Thank you to everyone who submitted them. Just as a reminder, we have plenty of great resources. They're attached at the bottom. You can always read our blog, our fandom articles, which you can find by going to our website. And please look out for the email after the webinar. Again, we're here to help, happy to help. And we can set up a free consultation session with you or one of us here at Aspiriant. Thank you, Nick and Lena, for sharing your advice and insights. Really valuable. It was a wonderful conversation. And thank you everyone for joining us today. Have a great weekend. And again, let's plan together. Thank you.
Thanks, Helen. Thanks,
Thank
Lena.
you, Helen.
Bye,
Thanks.
Lena. Bye, Nick.